In 2020, while the world was locking down and the global economy seemed to freeze, something strange happened. Starbucks opened 1,400 new stores, most of them outside the US. Tesla didn't stop. They poured billions into massive gigafactories in China and Germany. Samsung announced a $17 billion chip plant in Texas. We tend to think of the economy as you buying a coffee or a country selling oil to another, but there is a deeper layer, a massive, invisible current of money that flows beneath the surface. It decides which countries get rich, which cities become ghost towns, and where your next job will come from. It is called foreign direct investment, or FDI. It is the difference between a country surviving or collapsing. But in the last few years, the rules of this game have changed. Today, we are going to look inside the engine of the global economy to understand how money actually moves and why the factory of the world is moving to a new location. Foreign direct investment is a marriage. It is when a company in Singapore doesn't just buy stock, but buys a company in Vietnam, or builds a factory from scratch in India.
According to international standards, this happens when an investor takes at least a 10% stake in a foreign company. This gives them control. They aren't just sending money, they are sending technology, management, and strategy.
This usually happens in two ways. One, greenfield investment. This is the Tesla model. You go to a foreign country, buy an empty field, and build a brand new factory. This creates jobs instantly. Two, brownfield investment. This is the acquisition. You go to a foreign country and buy a factory that already exists. But here is the trillion-dollar question. Why? Why go through the headache of dealing with foreign laws, languages, and politics?
Business scholars have studied this for 5 decades, and it always comes down to 4 specific hungers. If a company enters your country, they are looking for one of these 4 things.
Motive number 1, resource seeking. Sometimes you just don't have the stuff at home. You need lithium, you have to go to Australia or Chile. You need cheap labor, you go to Vietnam or Bangladesh. Clothing companies don't move production to Southeast Asia because they like the weather. They do it because the cost of labor allows them to survive. Motive number 2, market seeking. This is the BMW strategy. American drivers love SUVs. So instead of making them in Germany and shipping them across the ocean, BMW built a massive factory in South Carolina. By the way, that factory didn't just serve America, it exported $8 billion worth of cars to places like China and Russia. Motive number 3, efficiency. This is about rationalizing the supply chain. Maybe it's cheaper to make the engine in Mexico, the electronics in Taiwan, and assemble it in the US. FDI allows companies to create a global web where every part is made in the cheapest possible location. Number 4, strategic assets. Sometimes you buy a company just to get their brain. If you want to learn how to make the best luxury fashion, you invest in Italy. If you want the best software engineers, you invest in Silicon Valley. On paper, this sounds great. The host country gets jobs, technology, and tax revenue. The investing company gets profits. A win-win, right? Well, not always. When a giant multinational corporation enters a developing country, it can crush local businesses. A local coffee shop can't compete with Starbucks' supply chain. Small factories get wiped out. Then there's the issue of pollution havens. Some companies move their dirtiest factories to countries with the weakest environmental laws. They export their pollution to the developing world. And finally, there is politics. Huge investments can lead to corruption. We've seen instances in Latin America and Asia where foreign money influenced politicians to change laws to benefit the corporation, not the people. This led to a time where some countries banned FDI entirely. But today, almost every nation practices pragmatic nationalism. They say, come in, invest, but follow our rules. But remember how I said the rules changed? For the last 30 years, money flowed to wherever it was cheapest. But after the pandemic and recent geopolitical tensions, money is now flowing to where it is safe. According to a recent report by MIGA and the World Bank, we are seeing two massive new trends: nearshoring, moving factories closer to home so your supply chain doesn't break, and friendshoring, moving your money to countries that are political allies. Investors are scared. They don't just want low costs anymore, they want predictability. They are asking, if a war starts, will I lose my factory? This means some developing nations might lose out, while others, those perceived as safe, are about to see a flood of new cash. Foreign direct investment is the invisible hand that builds skylines. When you see a crane in your city or a new factory opening in your town, look at the logo on the fence. It's likely not just a local business. It is a tentacle of a global organism connecting your local economy to a boardroom in Tokyo, New York, or Singapore. Money never sleeps. It just moves to where it's treated best. Thanks for watching. If you enjoyed this and learned something new, make sure to subscribe for more great content.